This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Example 1. On the 1st of, same as always, but with this one extra bit. On the 1st of January 2008, P acquired 80% of the shares of S, which was incorporated on that date. So again, clearly this time we only got 80%, but it's more than 50%. We control it. We're going to have to do consolidated balance sheet. But again, it was incorporated on that date. So we bought the shares on the day the company was formed. Okay? We've got the balance sheets. So S is exactly as always, current asset, non-current assets, share capital retained, blah, 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 blah. This, remember, is 2010. So when we bought the shares, they'd no retained earnings at all. It was the date it was formed. But 2 or 3 years later, fine. By then they've earned 8,000. P's balance sheet. Again, exactly as always, but P, of course, shows the investment in these shares. They'd paid 8,000 to buy the shares. Okay? Well, although it may be very obvious, we'd better check first of all, why had they paid 8,000? You know, had they paid for goodwill or anything? Well, it may be obvious, but no problem. The consideration from P's balance sheet, they'd paid 8,000. What were they buying? Well, it was on incorporation. It was the day it was formed. So they were simply buying the share capital the share capital of S, if you look, is 10,000 on S's balance sheet. But of course, if we're only buying 80%, you're paying for 80% of the shares. 8,000. Okay? And again, because it was bought on incorporation, there were no retained earnings, otherwise it would have been worth more. But irrelevant here. There's no mention of a fair value adjustment, and of course there wouldn't be. The day the company was formed, surely, the assets aren't going to be worth more than the balance sheet on that day. And so, no problem. I say, there's no need to actually write that down, but it made sense. We paid 8,000 for what we bought. Let's go straight into the balance sheet. Now here, quite importantly, it's easy, but make sure you understand me. The consolidated balance sheet even though we only own part of S, 80%, because P controls S, I said before, any votes, it's P who'll win, you know. So because P controls S, we always bring in all the assets of the group. The non-current assets. We control all of them. And so P has 30,000, S has 15, total 45. We simply add up, as always. The current assets. Again, I don't care whether we own 100%, 80%, whatever. We control all of them. You simply add up. P has 7,000, S has 6,000, total 13. Everybody? And so, the total assets of the group are 58,000. I know I keep repeating, but we are controlling all those assets because we own more than 50% of S. Who's it owed to? Well, of course, our shareholders. Share capital. Always the shareholders of P. It's those shareholders who are controlling everything, P and S. So the share capital of P is 25,000. They're also entitled to retained earnings. But just one little thing here, which I think is obvious enough. Surely the shareholders of P are entitled to everything P has earned. And on P's balance sheet, it's 15,000. They're also entitled to S's earnings, but although they're entitled, as always, to the earnings since incorporation, the post-acquisition, which here, because we bought it on formation, there's 16,000. Here, we don't own all those earnings because we only own, was it 80%? 80% of the company. And so we bring in our share of these earnings. Our share is 80%. How much has S earned? On their balance sheet it's 8,000. And so how much are we entitled to? 80% of 8,000. Is it 6,400? Total 21,400. Now clearly we've not finished yet. But does that make sense, everybody? And so the total belonging to our shareholders is 46,400. However, we have a little problem, which I think is a very obvious one. The little problem is, I've brought in all the assets of the group, 58. And you can imagine in a minute, we're going to bring in all the liabilities of the group. But we're now saying, despite the fact we've brought in all the assets, of course, my shareholders, P's shareholders, aren't entitled to all the money. You know, they're entitled to P, obviously. But of course, only 80% of S actually belongs to us. All right? And so we don't, in fact, own all those assets, even though we control them. Some of it is effectively owned by these other people. And so we need to show not only how much is owed to our shareholders, P's, but how much is owed to these other people. And here's where we show it. We put down immediately the non-controlling interest. How much is owed to other people? Well, how much is owed? Surely these other people own 20% of S. They're entitled, are they not, therefore, to 20% of the share capital? It was 10,000? 2,000? Sorry, squashing a bit. But also, surely, they're entitled to 20% of all the earnings of S as well. Would you agree? And so, the retained earnings. Again, they own 20%, they're entitled to 20% of the earnings. S has retained earnings of 8. You better check my arithmetic. But the non-controlling interest, they own 20% of S. They're entitled to. They're owed 3,600. All that remains is finish it, which is easy. But again, does that make sense, everybody? And so, 46,400 is owed to our shareholders, 3,600 to the others. The total is how much? 50,000? All that remains, of course, and no problem here, are the current liabilities. And always, as we've done all the way through, we'll simply show in total, add them up. There's 5 in P, there's 3 in S. The total, 8,000. And hopefully, I better check, we balance. Beautiful, no problem. All right? So, I hope sensible. But I cannot stress enough, although I think I've said it twice, always you bring in all the assets and liabilities of the group. Whether we own all of it, whether we own 80%, whether we own 60%, you bring in all the assets, all the liabilities, because whoever owns them, I don't care, it's my shareholders actually control them. Okay? So in total, the group is worth, the assets less the liabilities, but who's it owed to? Most of it, obviously, is owed to my shareholders. Share capital of P, our share of S's retained earnings. Some of it's owed to the non-controlling. They own 20% of S. 3,600, therefore, of the total is effectively owed to them. Okay? We're still not there, I'm afraid. But does that make sense? Hello? Inessa nodded, but nobody else did. Does that make sense? Lovely. All right. The reason we're not there, of course, think back to what we did before. In this example 1, we bought the shares on the date of incorporation, the date the company was formed. More likely, as we were doing in the previous chapter, more likely perhaps, we bought the shares when the company already existed. And so let's do one more before you have a coffee. Can you turn to example 2? As I say, just one more before you have a coffee. And then we'll have more fun after. Example 2. P acquired 60% of the shares in S. Oh dear, another typing error. Anyway, sorry. Acquired 60% of the shares in S on the 1st of January 2007. So P owns more than 50%. We control it. We've got to do consolidated accounts. All right? When the retained earnings of, I'm sorry, it should say S. I do apologise. When the retained earnings of S stood at 6,000. So the company already existed, it had already got retained earnings on the date we bought our shares. The fair value of the non-controlling interest at the date of acquisition was 30. I'll come back to that in a minute and explain what I mean. But, as usual, they've told us a few years later, on 31st of December 2010, there's the balance sheets of the two companies individually. S, exactly as always. The retained earnings, of course, are higher. With several years later, they've earned more. P, exactly as always. And, of course, there's the investment. The investment in S, they paid 40,000. Okay? Well, here we are going to have to do a bit of workings. Because if you remember from before, if we buy it after incorporation, then quite likely we paid more than the balance sheet showed it, sort of thing. We paid for goodwill. And so let's first of all work out any goodwill arising on consolidation. Now here, watch me very carefully. It's not hard. Rules are rules. By the time of the exam, it just becomes automatic. But I kept saying earlier, and I think it's important, the more you see the logic, the sense, I think the easier it is to remember. What did we mean by the goodwill before? The goodwill was the extra that we decided the company was worth over the balance sheet value. Am I making sense? If my balance sheet shows my business is worth 20, if we decide it's really worth 30, the extra is the goodwill. So we need to look at what did we decide the business was worth? What was it worth in the balance sheet? Again, the extra is the goodwill. Let's do it. First of all, at the date of acquisition, 1st of January 2007, what did we think the business was really worth? Well, we paid, how much? How much did we pay, please? 40. Well, fine, we may have thought the shares were worth 40, but that wasn't what we thought the whole business was worth, because we were only buying a percent. We were only buying 60%. Do you agree? And so, and this is the important bit, if I want to know how much S was worth in total, surely the total worth of S, 1st of January, is what we thought our shares were worth, 40,000, plus what we thought the other bit was worth as well, the non-controlling interest. Now, we can discuss later where this figure may have come from, although it's not your problem in the exam. You'll be given it. But it tells you on the second line of the question, the fair value, what you might call the true value, of the non-controlling interest at the date of acquisition was 30,000. You all found it? Now think about this. Clearly, the 60% I've walked away. Was it 60% we bought? We obviously felt that 60% of it was worth 40 because that's what we paid. Agreed? The question tells us that the fair value of the other 40% was 30. I say we'll discuss later where that may have come from, but if the question says it's 30, it's 30. You with me? And so on that basis, what was the company worth on the 1st of January? It was worth 70,000. Is everybody clear what I'm saying? But that doesn't have a name, but I'm saying that's the total worth or value at the date of acquisition. Well, goodwill, remember, is when we decide it's worth more than what would appear in the balance sheet. You agree? So what would have been the balance sheet value at the date of acquisition? Surely at the date of acquisition, the share capital in S was how much? How much was the share capital in S? At the date of acquisition. Bless you. Ooh, no tricks. Come on. What's S's share capital? 20,000. Yeah? His share capital is 20,000. I shouldn't have even said that. I mean, don't panic. There'll never be, oh, they've issued more shares or something. So if it's 20,000 now, it's 20,000 then. But at the date of acquisition, the retained earnings... Earrings. The retained earnings were how much? At the date of acquisition, 6,000. So the pre-acquisition retained earnings were 6. Sorry, have I got... Fine. You all right there? And so, I know I'm saying what I said before, but if we had S's balance sheet on 1st of January, if shareholders' money was 26 in the balance sheet, then the net assets of the company on that date in the balance sheet must have been 26. Do you agree? There's no mention of any fair value adjustment. There's unlikely to be. And so, you had a company P on the 1st of January. The balance sheet showed it as being worth 26. And yet, we're saying it was actually worth 70. This combination of what our shares we thought were worth and what the other people's were worth. And therefore, of course, if we think it was worth 70 and the balance sheet said 26, the difference is the goodwill arising on consolidation. 70 less 26. Is it 44,000? Are we all clear where that came from?
Where comes total worth? Why it is 70 and not 75,000? If 30,000 is 40%, and 100% should be 75.
Hey. I know what you're getting at, and I will... If you'll be patient, I'll say more later about where it might come from. But here, I know it might look funny, and what you're saying has some sense, but you do agree that we paid 40. You know, it says so, we paid 40. So, sensible or not, clearly we thought the shares we were buying were worth 40. So you don't disagree with that on its own. The question tells us, and I haven't said where this figure might come from, which is what the problem is, and I'll come back to, but the question specifically says the value of the other 40%, the non-controlling interest, was 30. Now, it may not seem logical. I know exactly what your problem is, and I am going to come back to it, I promise. But if the question says it's worth 30, and the question will actually give you a figure, then, if one bit's worth 30 and one bit's worth 40, the total is 70. All right? Now, I know what's worrying you, Irina, I really do. Why is one bit worth more than the other bit, sort of thing? Hello? But I beg you, be patient with me. Forget there might be a logic problem, but you'll see what I'm getting at. If one bit's worth 40 and one bit's worth 30, then there isn't much argument. The two together is worth 70. Okay? So you are clear for the minute, Irina? Is everybody clear? And what I hope everybody's happy with is if we accept that we together thought it was worth 70, since balance sheet value would only have been 26. You are all happy, you included, Irina, I hope, that the extra, she's gone now, but the extra is 44, all right? Everybody? All right, well, obviously we are going to do the consolidated balance sheet, but I want to get in the habit of doing working separately. As you've seen, the questions will say things like, what's the goodwill, or what's this, and so on. So, I want to do one more bit of workings, and then we'll set up the balance sheet. So, you've seen what happened there. I'm not going to keep repeating it. But there is going to be goodwill on our balance sheet of 44. The other bit of workings that's always going to be important, whether it's very easy or whether it needs more thought, is the retained earnings. Remember, in our balance sheet, we want to show the returned earnings that belong to our shareholders, shareholders in P. And so always it's 100% of P's retained earnings. Clearly our shareholders own them. P's retained earnings are 44,000. In addition, what about S? Well, two things. First of all, we've said in the earlier examples, we are only entitled to the earnings since we bought the shares. You agree? The post-acquisition. However, this time, we only own 60% of the shares. And so, it's always our share of the post-acquisition earnings. And how much is our share? We're entitled to 60%. How much in total are the post-acquisition earnings, please, of S? In total, what are S's post-acquisition earnings? Yeah. At the moment, the earnings are 16. At the date of acquisition, they were 6. And so it's only ever the post-acquisition, which is 10. But it's our share of them. 60% of 10, 6,000. And therefore, the retained earnings belonging to our shareholders are 50,000. Everybody? All right. One more bit and we've got it. We've got the goodwill. I'm coming back to your problem later, but otherwise we're happy. We've got the retained earnings. I think very logical there, I really do. It's just obviously with more bits you have to be that bit more careful. But finally, of course, you've already seen when I come to write up the balance sheet, we're going to bring in all the assets of the group, all the liabilities. But of course, some of it belongs to the non-controlling interest. Do you agree? So, let's finally work out the non-controlling interest. That's going to appear on the balance sheet. Now here, watch me. It's easy, but it might look a bit funny. Tell me, how much were the non-controlling people worth at the date we bought the shares? At the date we bought these shares. What were the non-controlling interest worth at that date? We bought them on the 1st of January 2007. Yes. It tells us again, and I know, sorry Irina, I've got to come back to it, but the question told us that on the 1st of January 2007, the date the group first came into being, the fair value of the non-controlling interest was 30,000. Forget balance sheet value. We said that was what it was really worth. We're now several years later, of course. And if it was worth 30 then, surely, if they'd been making profits since then, we expect them to be worth more. You would agree? Well, we want to know what the value is today, 31st December 2010. We add on their share of retained earnings since that date. Well, the retained earnings since that date are post-acquisition. And if we add that on, that's the worth today. What's their share? It's 40%. What are post-acquisition? It's now how much? 16? It was 6. It's 4,000. And therefore, the non-controlling interest, 34,000. All right? All that remains is the balance sheet. We'll have a break. Immediately after break, I'll do the balance sheet. But we've got all the figures. Okay?